Why is off-balance sheet financing crucial for shadow banks? Imagine a financial world where banks can lend money and create credit without showing all their assets or liabilities on their official reports. This is what off-balance sheet financing allows shadow banks to do. These financial entities act like banks but are not regulated the same way. They use special tools called off-balance sheet vehicles to keep risky assets hidden from view. This means they can lend more money, take on more risk, and operate more freely. Shadow banks are important players in the financial system because they provide services similar to traditional banks. They lend money, offer credit, and help move funds around. But unlike regular banks, they do not have access to central bank support or deposit insurance. Instead, they rely on short-term funding secured by collateral, like loans or assets. To do this, they set up separate entities called special purpose vehicles or conduits. These vehicles hold risky or long-term assets outside the main company's books. This setup helps shadow banks appear less risky and reduces the amount of capital they need to keep aside. It also makes it easier for them to raise money cheaply and lend more aggressively. They can create complex financial products like asset-backed securities or collateralized debt obligations. These products bundle loans or assets and transfer the credit risk away from the original lender. This recycling of capital allows shadow banks to keep lending and providing liquidity. However, this approach can hide the true level of risk in the financial system. Because liabilities and exposures are kept off the main books, it becomes harder to see how much risk is really out there. Before the financial crisis of 2007 to 2009, off-balance sheet financing helped shadow banks grow rapidly. They issued short-term liabilities backed by risky long-term assets, often at lower costs. This allowed them to lend to borrowers who might not qualify for traditional bank loans. But this growth came with dangers. The lack of transparency and oversight meant risks could build up unnoticed. When the market turned, these hidden risks contributed to the crisis. Off-balance sheet financing made it possible for shadow banks to expand credit quickly and cheaply, but it also created vulnerabilities. It allowed them to bypass some regulations meant to keep the financial system safe. In simple terms, off-balance sheet financing is like a financial trick that helps shadow banks do more lending without showing all the risks upfront. It makes their operations more flexible and efficient but can also hide dangers that might threaten the entire financial system. This method has evolved over time, shaping how credit and liquidity are managed outside traditional banking. It shows how financial innovation can both help grow the economy and introduce new risks that need careful oversight.